Well, ABFRL has announced that they will evaluate a vertical demerger of their businesses into two separate listed entities. As you can see, one would be the Madura fashion and lifestyle business, the other one would be the rest of the business. The question we are asking here is if this exercise can actually unlock value. So let's look at this whole exercise and the numbers itself. Now, as per the company's statement to the exchanges, what will each of these businesses hold? Let's start with Madura fashion and lifestyle business. It will hold brands like Louis Philippe, Van Heusen, their underwear business, which is growing extremely fast as well, Allen Solly, Peter England, then a couple of these new businesses like American Eagle, the young businesses Forever 21, and the sports business, which is Reebok as well. This demerges and lists separately. The remaining ABFRL business will hold Pantaloons, their vast growing ethnic wear portfolio, the luxury brands that they have, the bridge to luxury brands as well, and a bunch of digital brands known as Tomorrow. So it appears with this that we can classify these businesses in two parts. One is the value generator, the other one is the growth generator. Why do I call them so? Let's start with Madura lifestyle and fashion brands. We have a 5% revenue growth for this business. Large part of the revenue comes in 6350 odd crores in the first 9 months of this year, with almost 1000 crores of EBITDA at a margin of 15.5%. Whereas the other business, the fast growing business, grew at around 21% in the first 9 months of this year with a revenue of around 4500 crores. Of course, because it's in an investment phase, the margins are a lot lower at around 8% itself. If the current growth rate continues with additional kickers coming in from improved consumer sentiment and business focus as well for the next 2 years, for Madura Garments, which has grown at around 5% for the first 9 months of this year, we can assume a revenue compounding of 10% and an EBITDA compounding of over 12% for the next 2 years. And for AB Fashion and Retail, it's a growth driver and we will see some operating leverage as well, which is why I have assumed 22% revenue growth and 25% EBITDA compounding as well. We end up with roughly 11,000 crore revenue and 1800 crore EBITDA for the Madura fashion and lifestyle business for FY26. Whereas for AB Fashion and Retail, the numbers are close to 10,000 crore on the top line with 800 crore on the EBITDA itself. So big question then is how to value these two entities. I'm looking at comparable numbers for companies like Trent. It would be then prudent to ascribe a huge discount to Trent, which trades at 45 times FY26 EV to EBITDA, and give it similar multiples to players like Arvind Fashions as well, and also given a higher multiple to the AB Fashion and Retail business largely because of higher growth prospects. So look at 20x EV to EBITDA for AB Fashion and Retail and 15x for Madura Fashion and Lifestyle itself. You end up with an enterprise value of 15,700 crores for AB Fashion and Retail and 26,600 crores for Madura Fashion and Lifestyle, which takes the total enterprise value to 42,000 crore as against the 26,000 crores it is at right now. Before jumping to all the conclusions, what are the factors that we should focus on? The first one, what is the exact cash on books post the GIC fund infusion? What the total debt and payables are of the company? 9,300 crore as of September. How will this be split between the two entities? The third one, what is the expected growth capital infusion in ABFRL and the resultant dilution on that? And finally, the path to profitability and growth for both these divisions, how they play out, will be important to see the value that will emerge from this entire exercise.